We get a lot of questions from married borrowers or borrowers who are thinking about getting married in terms of what is the impact of marital status on repayment. So we're going to take a look at that in module number 6. In this module, we're going to look at 4 different things: the impact of marital and tax filing status on the income plans. We're going to look at community property states. We're going to look at married borrowers and refinancing with private lenders. And then we'll show you how to estimate payments for married borrowers filing jointly and filing separately. Now, with the federal repayment plans, remember in an earlier module, we talked about a lot of different plans, but that they all fall into one of 2 categories: time-driven and income-driven. If you're using a time-driven repayment plan, standard 10-year or extended 25, marital and tax filing status have nothing to do with the calculation of the monthly payments. It may have everything to do with whether or not you can actually afford a time-driven plan, but the actual payment calculation in a time-driven plan has nothing to do with your marital or tax filing status. However, as you know from an earlier module, if you're using an income-driven repayment plan, marital and tax filing status may impact the calculation of your monthly payments depending on which plan you choose and how you file your taxes. Now, we showed you this slide in an earlier module on the income-driven repayment plans, but take a look at it again. If you are married filing a joint tax return, it doesn't matter which income-driven repayment plan you're using. Spousal income will be counted. It will be on the tax return and it will be counted. Spousal federal debt is also factored into the payment calculation when spouse's income is being used. However, the only way to exclude spousal income from the payment calculation with an income plan is to file a separate tax return and use pay as you earn, in some cases the much older income-based repayment plan known as IBR. And that's because repay always counts spousal income in the payment calculation. You can use the loan simulator to estimate payments filing jointly versus filing separately. We referenced this chart earlier. We actually did a more detailed look at this when we talked about pay and repay, but this is on our homepage, PGPresents.com. This is the more detailed comparison of all the income-driven repayment plans. We've highlighted once again spousal income. Yes, if you're filing a joint tax return, but no, if you file separately and you use pay as you earn. So there you see the differences again: married filing jointly and married filing separately. Now let's talk about community property states. We are not tax advisors, but if you live in a community property state, the money earned by either spouse while married and all the property bought with those earnings is considered equally owned by each spouse. There are 9 community property states: Arizona, California, Idaho, Louisiana, Nevada, New Mexico, Texas, Washington, and Wisconsin. Why is this important? Remember that if you are filing a separate tax return for the purposes of excluding spousal income and you're using pay or the much older IBR, half of your spouse's income is likely going to be reflected on your federal tax return. In other words, the tax return is going to show more income than just yours alone. Work with your loan servicer to request that spousal income in these cases be excluded from the payment calculation, and the Department of Education has provided guidance to the loan servicers about this. In other words, the Department of Education knows that married borrowers living in community property states who file separately are going to be penalized if the loan servicer uses the income on the tax return, because half of it, or at least a portion of it, is going to be the spouse's income. There is something called alternative documentation of income. This is really just a letter or information that you can send to your loan servicer that says, of the amount listed on my tax return, this much is mine and this much belongs to my spouse. So once again, very important, if you're married filing separately for purposes of lowering your monthly payment with pay or IBR and you live in a community property state, you're going to need to work with your loan servicer to be sure that they exclude your spouse's income. Now, what about married borrowers and refinancing? This is actually quite simple. We have said on 2 occasions that spousal federal student loan debt is factored into the payment calculation for married borrowers using an income plan if the income plan is including spousal income. Once again, it's not a wash. We said that if your spouse is making $50,000 a year and he or she has $50,000 in federal student loan debt, it's not as though they have no income. But the inclusion of federal student loan debt of your spouse will help to lower your payment. If your spouse were to refinance his or her federal loans into a private loan, the private student loan debt cannot be factored in to the payment calculation in the income plan. So be careful if you're married and your spouse is considering refinancing with a private lender, because that could adversely impact your monthly payment. Now, there are at least 2 different loan calculators you may want to use if you're curious about estimating payments if you are married or considering getting married. The loan simulator at studentaid.gov is very easy to use to estimate the impact of spousal income and spousal federal debt on the monthly payments under income plans like pay and repay. There's a simple drop-down menu where you can say we are married filing jointly or we are married filing separately. Please note the asterisk. This calculator is very good for determining monthly payment amounts, but it does not recognize the difference between a resident and an attending physician. So do not use the loan simulator for total repayment and forgiveness amounts. But just to do a quick calculation of the monthly payment, married filing jointly, married filing separately, it's terrific for that. The AAMC MedLoans Organizer and Calculator called MLOC has a special enhancement for married borrowers. We would strongly encourage you as a medical student to take a look at this calculator and to use it. It is a terrific resource and will be very helpful for you, especially if you're married or thinking about getting married. We hope the information in this module has been helpful to you if you are married or considering getting married and you're looking at the impact of that on your repayment plans. This is the end of module number 6.